We do not believe this is a Lehman-like moment, but we do believe there are some banking issues out there. Oh my gosh, they're going to be forced into selling these held-to-maturity securities. If that happens, then we have a severe recession. If employment and output are moving up, then the risk is that inflation will move up as well. The history of the last 40 years, on balance, suggests that is just false. We had inflation and interest rates coming down pretty consistently from the early 1980s until 2020, so 40 years. And during that time, some of the strongest economies with the best employment gains and output gains were in periods when inflation was coming down. And the link there is that when you have strong output growth, you tend to have strong productivity growth as well. And productivity, so output per man hour, enables companies to actually pay higher wages without increasing their prices, or they can increase their margins without increasing their prices. Now, very recently, companies have been doing the opposite. Companies, even like P&G, have been relying on pricing to maintain margins. Why is that? Well, as prices went up, the consumers started pulling back. P&G's volume growth in the fourth quarter was down 6%. That's crazy. That's very unusual for a staples company as well. So basically, the consumer is saying no mas. And I think while many at the Fed and elsewhere think that these higher prices are going to be perpetuated, and we'll get into the wage structure, I think we're seeing quite the opposite. If volumes continue to be hit because the consumers are saying, no, I'm not going to be buying that anymore, well, the hit is going to be to margins. So I think monetary policy narratives have to change a bit here. And they haven't yet. Chairman Powell was out this week in front of Congress, both houses of Congress, sounding very hawkish. Why? Because some of the economic indicators that have come out recently look strong, including initial unemployment insurance claims. They're going down, suggesting employment is doing fine. But we're beginning to see brewing here a banking crisis. And the question we have to answer is this going to become systemic, like Lehman Brothers in 08 or 09? Or, and we're betting on this latter one here, is this more like 1994 when Orange County went broke, and that created a crisis to which the Fed responded? We think it's much more like 1994 because the setup was similar. In 93, 94, commodity prices had taken off as we were coming out of that recession. It was an S&L-induced recession, so housing. And the Fed was railing against those price increases with higher interest rates. It was a terrible year for growth stocks, and that's how we would characterize 2022. But when Orange County went bust, that was a sign that the Fed had gone too far, and the Fed did change its spots. We believe that the failure of Silvergate Bank and Silicon Valley Bank, which just went, the FDIC put it into receivership today, both of those are telling us a couple of things. One, that, the Fed has gone pretty far and is causing a lot of banks, not just these, difficulties. And I'll describe how in a moment. So we do agree with those who say, well, Silvergate had a concentration of crypto customers, And Silicon Valley Bank had a high concentration of venture and venture-related customers. And so that's all true. But if you look at what has happened here, it is the deposit outflows that have triggered the problem, the crisis. We know that venture capital is facing a bit of a liquidity squeeze. Fewer deals are being done. There is more risk aversion in the marketplace. And so these companies are having to draw down their deposits. Most bank with Silicon Valley Bank. They're drawing down their deposits because they have to. And there are others perhaps at Silicon Valley Bank who are saying, wait a minute, I'm not being paid anything here at this bank, or not paid very much, so I'm just going to put my money in a money market fund until I need it. A lot of banks are facing that latter risk. If you look at the money center banks, the big banks, they hardly pay anything on deposits. And so money is fleeing to money market funds. Now, that's not going to present a difficulty for the big money center banks. They are extremely well diversified. Most of them have nothing to do with venture, or if they do, it doesn't represent a big percentage of their business. But there are smaller banks out there that are facing some issues. And I'll just say one more thing about the large banks. Because of what happened in 08-09, they have been forced by regulators into capital ratios, which suggest that today they are extremely well capitalized, and they're like Fort Knox, so very safe. So this is no Lehman moment. However, there are small regional banks out there who were not subject to the same kind of capital ratios, and they therefore have been taking business that used to go to the large money center banks, perhaps disproportionately, and moving more into funding venture companies, or they've been moving into commercial real estate. Historically, they've had a big position in residential real estate. As you might imagine, local banks know their local customers, and so real estate, residential real estate. But now, on average, 25% of their loan book is in commercial real estate. And what we have to watch here is the office part of commercial real estate. Offices are empty now. There's been a lot of building going on, and those new buildings are getting all of the attention, and the older buildings are really the vacancy rates are quite high. So we are seeing what is called strategic defaults, and what that means is that the borrowers are going back to the lenders, like these regional banks, and saying, our vacancy rates have gone up. We can't, our cash flows aren't there. We got to renegotiate this loan. So we think there are going to be a lot of renegotiations, and it will halt a lot of activity. And I do think that it will get into the economic statistics. So I just want to make sure you understand, we do not believe this is a Lehman-like moment, but we do believe there are some banking issues out there, and certainly the bank indexes in the stock market. If you look at them, you will find the regional banks have been disproportionately hit in here. The money center banks haven't been doing that well, but they're kind of steady state. So the market is making that distinction. So just a little bit more of what has happened here. During 2020, when we were going through COVID, there was a huge amount of stimulus, as you will all remember, and many banks had incredible inflows, deposits, and both Silvergate and Silicon Valley Bank were two of them. So here we are. Now, what are they going to do? Well, Silvergate really didn't make loans. So it bought securities, liquid but long-term oriented securities, fixed income. And you'll see that Silicon Valley Bank did that as well. Silicon Valley Bank, which went under, took all that money, and if I remember, it was in the $70 to $90 billion range, and put it into these long-term instruments to earn a higher yield than in the money markets. At that time, money markets were paying maybe 0.5%, and they got 1.6% on average on that money. Now, the assumption they were making is that interest rates were not going to go anywhere anytime soon. And of course, that has proven to be wrong. Interest rates, as I've mentioned on this webinar many times, have gone up, I think it's 20-fold in less than a year's time. That has never happened before. And I hearken back to 1981, when Volcker was trying to squeeze inflation out of the system. He took interest rates up twofold, from 10% to 20%. True, a high level, but the shock, already people had gotten used to interest rates going up, so they were preparing for it. So the shock from going from 10 to 20, there was some shock value, but nothing like we're seeing now. And here are some of the ramifications. Now, many people, in comparing to 1981, they say, well, the yield curve is the same as it was back then. And my answer to that is an inverted yield curve of 100 basis points when long-term treasury yields are 4% or less. That's like a 25% inversion if you're trying to measure it, get a sense of sizing it relative to 1981. So 100 basis points over 4%, 1 over 4, 25%. If you go back to 1981, that 100 basis point inversion was against 15% interest rates. So that's more like 6 to 7%. So I would submit that this is sending 4 times the signal that inverted yield curve sent in the early 80s. And I think we're beginning to see some of the ramifications. What the problem for Silicon Valley Bank, which was considered a very fine bank, had an amazing reputation. Yes, it had customer concentration, and yes, it probably started making bad decisions, just helping GPs, general partners of venture capital funds, fund this, that, and the other without really studying, thinking, and assuming that venture would go on forever. We haven't had down rounds in quite a while, and it would go on forever. Well, that also was an incorrect assumption. So what happened? Deposits left, and it was forced to sell securities, which it was holding at a loss. And these are held to maturity securities, which those losses don't really show up unless they're realized. And so they had no choice but to turn to both all of the securities that were available for sale. They sold those at a loss, I think a $1.8 billion loss. They tried to do an offering to fill that hole, an equity offering of $2 billion, and the market absolutely rejected it. And that's when we knew, oh my gosh, they're going to be forced into selling these held to maturity securities because they're upside down. In order to attract deposits, they would have to increase interest rates dramatically. And even then, because they're so focused on the venture capital community, which is actually calling capital, those deposits were being drawn down because these companies haven't been able to do new rounds, and many lose money. And so they were forced to take down deposits. So it was in a very bad way. I think the mark-to-market losses were $15 billion, and its equity position was only $12 billion. So effectively, it was insolvent, having to recognize those losses. And so here we are. So again, I'm just explaining what happened. There are some other regional banks, we think, in a similar position. Maybe they've catered a little bit too much to the VC community. Maybe they are in the middle of negotiating on non-commercial loans, office buildings, and are having to mark those down as well, or the market is seeing that could be the case. So just wanted to explain that a bit. Now, the other thing that I've been really focused on, and it is an esoteric concept or topic, I should say, and I have mentioned it before, but it is at this time that it's very important. If money growth on a year-over-year basis is negative, there is an equation out there in economics called MV equals PQ. Money times velocity equals price times volume. Now, if money and price times volume is GDP, nominal GDP. So if money is going down, what is keeping nominal GDP from going down? It is an acceleration in the turnover of money. And that usually happens in risk-on situations where confidence is very high. And it sometimes happens out of necessity, which has happened very recently. Now, the concern here is that this banking crisis, I would call it a mini crisis, is because of muscle memory associated with the crisis in 08-09, is going to cause individuals and corporations to slow things down a bit, not take that extra risk, make sure they have a big enough capital cushion. And then there's another thing that might be causing that. The student loan moratorium, it looks like it will end in June. So in July or August, the consumers that have been enjoying that moratorium will have to turn around and start repaying those loans. In preparation for that, they might be slowing down purchases. So this idea, money going down, if velocity also goes down, so the rate at which money turns over because people are becoming more cautious, want to build their cash cushions, if that happens, then we have a severe recession. That I've been saying recently, how could we have a severe recession if housing is already down 40% by some measures? In fact, it's interesting to note that existing home sales are at 4 million units at an annual rate as of the last reading. When I started in the business, 1977, I was in college, existing home sales were 5 million back then, and the population's much larger today. So that's really saying something about where housing is.